Hello, everybody. My name is Bennett Tchaikovsky, the accounting professor here on YouTube. I am sharing with you a problem that I'm creating for my Accounting 1A honors course this fall 2025. Basically, whatever content you're seeing here represents the opinions of myself and not my employers or any other affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. I'm just here to help you guys have some fun with accounting. So on 1/1/29, we sell YYZ sells inventory to XYZ for $2,000. XYZ will repay the $2,000 to YYZ on December 31st, 2031. No interest will be paid on the amount by XYZ to YYZ. Then we're given over here that the relevant market rate of interest is 10%. The inventory cost YYZ 1,125, and then assume that once the inventory is sold, YYZ has no future obligations to XYZ. So we're asked to go through over here and prepare the journal entry on 1/1/29, prepare the adjusting entries for YYZ on 12/31/29, 12/31/30, and 12/31/31. And then we'll also go here, and I'm just going to make this one little change on 12/31/31, basically for YYZ. So prepare the same entries as above, except for XYZ. Okay, so when we look at a couple different things are going on here, when we're looking at the concept of revenue recognition, there are 5 different components essentially to revenue recognition. And essentially there's 5 steps, and this was established a little while back, but there's 5 steps to recognizing revenue. Now, when I'm teaching financial accounting, what I'm usually just saying at the lower division level, did we do everything we need to do to go through and to earn that revenue? However, from an intermediate accounting standpoint, and when we look a little bit above, that's not necessarily correct. But at the upper division level of intermediate accounting, we're going to be going through over here and following these 5 steps. We're going to identify the contract with the customer. Could be verbal. Those usually aren't going to be nearly as well enforceable. But if I'm walking into a 7-Eleven to go buy something, the clerk is not going to make me sign a contract. Second one is identify the performance obligations in the contract. Third is to determine what the transaction price is. Then I'm going to go through and allocate that transaction price to the performance obligations. And then once those things start happening, I'm going to go through and recognize revenue. So this is, even though this is AI generated courtesy of Brave, it is absolutely, in my opinion, it is absolutely correct. So when we look at this over here, there's a few things going on. So the first thing is we have a sale of inventory. So when I'm selling inventory, there's really 2 different things that are happening. So I have my assets are equal to my liabilities plus my owner's equity, expenses, revenues, and then debits and credits, right? So when we look at this here, right, I record assets with a debit. They're increased with debits, decreased with credits. Liabilities and equity typically have credit balances. They're increased with credits, decreased with debits. I record revenues with credits, and I record expenses with debits. So now that we kind of go through that on 1/1/29, whenever I sell inventory, the journal entry that I use to go through and to sell inventory is always going to be the same. I'm going to be, if I'm selling it on account, I'll be going through and debiting accounts receivable. I'm going to be crediting sales. I'm then going to be debiting cost of goods sold, and I'm going to go through and credit inventory. Okay, and naturally, my normal thing would be, oh, I'm going to record this sale over here for $2,000. This thing cost me $1,125. Now, again, when we're going through and selling inventory, right, there's 2 things that are happening, right? It's like we're leaving the Costco store. So Costco goes through, they record the sale. This is usually going to be for in cash. Then they have to show the inventory going off the books. So I'm going to record cost of goods sold, which is an expense of selling. So the sales is revenue. I record revenues with a credit. And then over here, I'm debiting accounts receivable with a debit because the customer has not yet paid me. Now, the problem though with this right over here is that, is this really $2,000? And what I mean by that is because, well, I'm here at 1/1/29, and then we've got the passage of time right over here. So this is 12/31/29, 12/31/30, and then 12/31/31. So if I was to record this as a sale right here, right? If I was getting money right here on January 1st, that would be absolutely fine. We would be done. It'd be exciting. We'd be over with this question. Then it wouldn't be as fun as what we're going to be exploring right now. But what I have to go through and do is to say to myself, well, as I'm looking at this over here, this is not really 2,000. Why is it not really 2,000? Because theoretically, I could take this 2,000 today is not the same as 2,000 over here. Why is that? Well, it's because if I could earn interest at 10%, right, what would happen every year? Well, this would grow to 2,200. Then this would grow again if I was able to earn interest on interest, and this would able to grow again to over here. So $2,000 today at a 10% interest rate would essentially get me over here to this new value, right? So $2,000 to be paid 3 years from now is not the same as $2,000 today. So what I need to do is to figure out, well, what amount would I invest today to get to $2,000 3 years from now? And this is where we're going to kind of go through and look at the concept of present value. When we're going through and looking at present value for something like this, we're basically saying to ourselves, well, I'm going to be getting this amount in 3 years. So what amount would I need to invest today over a 3-year period to get me to $2,000? So the table I'm going to use, because it is a lump sum, it is going to be the present value of $1. I'm going to take 2,000 times present value of $1, and the factor that I want is its 3 periods where interest is being compounded, and the relevant market rate of interest, which I have to give this to you. So this is going to be 3 periods at 10%. So let's go ahead and take a look at that table. If you have never used present value tables before, I strongly suggest to you that you go through and look up bonds. So 3 periods at 10% is 0.75131. So right over here, I'm going to go ahead and take this 0.75131, and I'm going to multiply this by the 2,000. I'm going to get 1502.62. Okay, so what exactly does this mean? Well, if I took 1502.62 and I invested this at 10%, what would the value of this be? Well, at 10%, I would earn year 1, year 2, and year 3. I would earn $150.26. I add this in over here, my ending balance is $1,652.88. I reinvest this again at 10%, and I'm basically earning $165.29 on my money. Now the value of that amount has gone to $1,818.17. And then lastly, I'm going to go ahead and reinvest that. I'm going to earn $181 worth of interest. And now this balance over here at the end is going to be $19.99, or a great Prince album. But for us, it's just another fun, bad dad joke accounting reference. So when I see this over here, right, what I have to kind of delineate is this. I need to go through and kind of say to myself, well, the accounts receivable, right, maybe $2,000, right? However, it's not really 2,000 because part of this really represents interest. So what I'm going to go through and do is I'm going to go over here and say, well, 2,000, which is the amount that's owed to me in 3 years. And I'm going to subtract my present value that I just went through and completed. And essentially over here, this is going to come up with the difference of 497.38. And what we're going to do, and by the way, should we call this accounts receivable? Probably better to call it a note receivable, right? Probably do a note. That's probably what it should be, but accounts receivable, notes receivable. To me, it's somewhat interchangeable. I would probably rather call it a note though, because then it's going to be a non-current asset. So then over here, right, I'm going to have a discount on notes receivable. And my discount on notes receivable is going to be over here at 497.38. Now, when I look at this, though, I kind of have an issue, right? Because my issue is over here, like, well, Bennett, you recorded this notes receivable here, or accounts receivable, or a note receivable. Over here, you recorded this at $2,000, but we can't, the problem is, well, part of this really represents interest, right? Because this part over here, because I could take this 1502 and reinvest it every year. So the amount I'm going to be going through and recording as a sale is going to be not 2,000, but it's going to be 1502.62, or what I had basically done the present value computation for. So let's take a step back again and let's kind of look at this, because this is by far the most important concept when we're going through and looking at this problem. So when I see this over here, I sell inventory. Normally, if I'm selling inventory on account, debit AR, credit sales, debit cost of goods sold, credit inventory. Seems simple enough. However, I'm not being paid this $2,000 right away. It's not coming to me in the next 90 days, next 30 days, next 60 days. It's not coming to me for another 3 years, right? So the thought is, well, why is it not the same thing? Because if I got $2,000 today, and if the relevant market rate of interest is 10%, then theoretically I could make this thing grow to 2,662. So we know that $2,000 3 years from now is not the same as $2,000 today. So what I then need to do is I need to take that $2,000 amount, and I then need to go through and say, all right, 3 periods at 10%, right? Present value of dollar, which is used for a single payment. Very important, a single payment. 3 periods at 10% is 0.75131. I put this here and I get a value of 1502.62. How do we know this is correct? Well, if I invest this right now at 10%, I'm going to earn $150.26 in interest. It comes to 116.5288. Take that amount, reinvest it the following year at 10%. I get 165.29. Ending balance, principal plus that interest is 18.17. Take that balance over here, multiply by 10%, get that interest earned, and I'm going to end up with about $2,000. So I know that that is correct. So when I'm going through, the real amount of the sale is effectively 1502.62. But what the customer is going to ultimately pay me is not 1502.62, rather it's going to be $2,000. So what I need to do is I need to take this discount on notes receivable, right? And when I do this, what does this mean? Well, on my balance sheet as of 1/1/29, balance sheet under my non-current assets, right? I'm going to have a note receivable over here for $2,000, less my discount on notes receivable for 497.38. And this is going to give me notes receivable net of 1503. So you kind of see how that works, right? So on our balance sheet, again, do they really owe us? They owe us $2,000, but it's not until 3 years from now. So on our balance sheet, what we need to be showing to our investors is really, well, it's not really, it is that amount, but we're not going to be getting it for a period of time. So that's why we need to go through and to disclose it this way. Now, let's take a look at what happens on 12/31/29. So at 12/31/29, we've actually, some time has passed, right? Basically, like a year has passed. So what I'm going to go through and do is that really, what is this about? This discount on notes receivable is effectively my interest revenue, right? Because this is a zero interest bearing note. And under accounting, we know that, hey, this is really interest revenue. So we need to show that accordingly. So what's going to go through and happen is that I'm going to go through and make a journal entry. Okay, so right over here, I have a discount on notes receivable. My discount on 1/1/29 was over here for 497.38. Okay, so right over here, I have this discount on notes receivable. This is a contra asset account. It's really holding in that interest revenue. So what I'm going to do as at 12/31/31, I'm going to record interest revenue. And for the interest revenue, how much am I going to go through and record? Well, I'm going to take the carrying value of the notes receivable net. And as of right now, as of 1/1/29, that is 1503 or 1502.62. I am then going to go through and multiply this by my interest rate. My interest rate is at 10%, right? That's what I discounted this back. By the way, if the interest rates changes, we don't care. We use the market rate of interest or the relevant rate of interest when we did the initial present value computation. So my interest revenue is going to be right over here at 150.26. How do I record revenue? Well, how do I record income or revenue? I record that with a credit. So right over here, I'm going to go ahead and record interest revenue. For every credit, I need a debit. So I'm going to basically be debiting discount on notes receivable. So this is going to be as of 12/31/29. And my balance in my discount on notes receivable as of 12/31/29 is going to be 347.12. So I'm going to come right over here to look at this balance sheet, 12/31/29. So my note receivable amount has not changed. I'm leaving that the exact same way, but my discount on notes receivable is now 347.12. for a notes receivable net of 1653. Remember, when you're getting money in the future, it's not the same as the money today. So what we're doing is we're saying, well, the sale is really, we made a sale of 2,000. Part of it is going to be a sale, which is the present valued amount. Part of it is going to be a discount on notes receivable, which is really how we go through and recognize our interest revenue. So every single year, what we're going to be going through and doing is we're going to be going through and debiting discount on notes receivable, crediting interest revenue. So this is going to be as at 12/31/29. And this is going to be for 150.26 and 150.26. Okay. So that's what we would do. This is my journal entry. Remember, for this year, there's really nothing else going on besides interest because there's no dollar payments that are coming through. Next one over here is going to be at 12/31/30. Let's go ahead and take a look at what's going on over here. So my note receivable has not changed, but we need to go through and compute the carrying value. And this is as a 12/31/29, 12/31/30. So my note receivable net after the last payment is 1,653. My interest rate is at 10%. So my interest revenue will be at 165 or 165.29. Okay. Now, what happened with interest revenue? Well, interest revenue, like all revenues, expenses, and dividends, gets closed out to retained earnings, right? So this over here at 12/31/30, I'm going to be recognizing interest revenue of 165.29. How do I recognize revenue? ERDC, right? I'm going to recognize that revenue with a credit. So at the same time, I'm going to be looking at my discount on notes receivable. When I look at my discount on notes receivable, this over here had a beginning balance on 1/1/30 of 347.12. But what happened here, right? Remember, this is my opening balance, right? Why is this a credit for my discount on notes receivable? It is like a contra asset account. It's reducing the carrying value of my note receivable. So over here, I'm going through and I'll make this a little bit cleaner. So for 12/31/31 or 12/31/30, excuse me, 12/31/30, I'm amortizing this by 165.29. So my ending balance on my discount on notes receivable is now going to be 181.83 at the end of the period. So I'm going to come over here to 12/31/30, and I'm going to go through and record interest revenue of 165.29. I'm debiting discount on notes receivable for 165.29. Crediting interest revenue for 165.29. When it comes to my discount on notes receivable, my unamortized discount is going to be 181.83. So now my note receivable net carrying value is going to be 1818. So almost there, right? This thing's being paid off on 12/31/31. Now for this part over here, what I want to go through and do is I want to go through and record that interest revenue. Okay, so let's go ahead and do this again. So on 12/31/31, my carrying value at the very beginning of the year was that 1818, my interest rate. So my interest revenue for the year is going to be 182. Okay, so when it comes to this part over here, okay, on 1/1/31, my opening balance and my discount on notes receivable was 181.83. Okay, the amount I'm going to record as interest revenue is essentially going to be this 182. Okay, when I go through and look at this, something miraculous happens. When I go through and record this interest revenue, this discount has effectively gone down to 0. So what I'm going to go ahead and do at 12/31/31, I'm going to go ahead and record basically the remaining amount that was basically over here, or this 181.83. And so now over here, and this is prior to any payment, my balance in this account, if I do 181.83, my balance here is 0. Okay. Now, okay, so the first thing I went through and did is I recorded the interest revenue, but I have one other thing that's happening. Finally, XYZ is repaying me. So when XYZ goes through and repays me on 12/31/31, I'm going to be debiting cash and crediting accounts receivable or notes receivable, essentially over here for $2,000. Okay. And you might be asking yourself, like, so this is happening as of 12/31/31. And so this is happening essentially like 3 years down the road, right? And why are you saying, wow, this is when we're actually getting the cash? Because remember, this wasn't really $2,000 3 years from now is not the same as $2,000 today because of the factor of interest. So when you see a payment being paid off in the future, you need to immediately think to yourself, wait a second, what about interest? $1 today is not the same as $1 tomorrow. So let's keep on going. We're now going to do this from the other side. So let's go ahead and take a look at this other side. So now we're going to be looking at this from the perspective of XYZ. So over here for XYZ, XYZ is basically purchasing inventory. I'm paying $2,000 for inventory and I'm crediting notes payable or accounts payable. Now, remember, I would probably phrase this, they would sign a note, because when you think of accounts payable, there's a notation or there's a consideration that it's going to be a current liability. However, this is not being paid for a period of 3 years, right? So we're just doing the opposite side of the transaction. Well, we've got the same issue here, right? And what is that issue? Well, $1 today is not the same as $1 tomorrow. So if I'm not paying out $2,000 until 3 years from now, this is really not the same thing. So what I need to go through and do is to say a present value of $1. This is not being paid out. I'm not going to have to pay it out for 3 periods at 10%. And this is going to be the same present value factor of 0.75131. Again, how did we get this? For lump sums where only one amount is being paid, go to the number of times interest is being compounded. In this case, it's 3, basically at 0.75131. So come over here and I say, well, the present value of this is 1502.62. So the note payable or the account payable that I'm going through and going to be recording is not really, well, it says $2,000, but on my balance sheet, it's not really worth 2,000. It's really worth 1502.62 because I'm not going to have to pay it for 3 years from now. So what I'm going to do is I'm going to record a discount on notes payable. I'm going to record a discount on notes payable for the difference over here of 497.38. Okay, because this is really what my future obligation is. It's not 2,000 because this is not 2,000 that has to be paid today. This is 1502.62, and I show this on my balance sheet over here. So XYZ balance sheet. And by the way, really quickly, if I'm looking at this balance sheet over here for this part, essentially by this point in time, and this is actually, I'm glad that I caught myself because this is not necessarily correct, because when we get over here to these, essentially when we're doing our balance sheet at this point, this is going to become a current asset. And what we're going to have here is we're going to basically have notes receivable less the discount on the notes. And these amounts here are going to be effectively be coming up to here. Yeah. So it's going to shift. Why is it shifting? Because when I'm doing the balance sheet, by definition, a current asset is something I'm going to be getting in the next year, right? So as of 12/31/30, this amount is going to be paid to me. Non-current asset is more than a year, so this is where it's going to be kind of going through and splitting. So now that we've learned from our mistakes, right over here on my balance sheet, under non-current liabilities, I'm going to have notes payable less my discount on notes payable. Okay, so right over here. So right over here, as of 1/1/29, this is going to have a balance of 2,000. My discount on notes payable initially is going to be 497.38. This is a contra liability account. It's very similar to a discount on bonds payable. So my notes payable net is going to be 1502.62. Now, going back to this initial entry, I have a problem. What's my problem? Well, do I record the inventory at 2,000? And the answer is no, because that's kind of overstating our inventory. So we're going to record it basically at the net present value of, at the present value of that future $2,000 payment. So this is going to be to record purchase of inventory. Okay, so that's going to be our first step. So we've got over here, this is our first step. Now, when we get to 12/31/29, similar to a discount on notes receivable is really another way of saying interest revenue, right? Because that's really what this represents, because the value of that future money today is not 2,000, it's 1502.62. So we needed to go through and recognize interest revenue. Similarly, over here, this discount notes payable is really, it's really basically interest expense. So what I'm going to need to go through and do is coming over here as of to record the interest expense, my carrying value as of 12/31/29, note payable, I should say notes payable net. My notes payable net balance was 1502.62. My interest rate is going to be at 10%. Okay, I have to, if I'm doing this question, I would have to basically give you that rate. So unless you're taking some, one of my students right now is suffering through, he's studying for some actuarial exam. Yep, it's 1A honors, so you're going to get those kind of students, which is awesome. That's why I love to teach that class. But coming over here, my interest expense is going to be $150.26. Okay, so how do I go through and record the interest expense? So I have over here, so I record interest expense. How do I record interest expense? Well, expenses are recorded with a debit. So I'm going to debit interest expense for $150.26. And what am I going to credit? I'm going to credit discount on notes payable for $150.26. Now, when I do this, I actually had an opening balance in my discount on notes payable when I first went through and did this. When I recorded the transaction of $497.38. So my initial balance in discount on notes payable was $497.38 debit. Good job, Bennett. So I had a debit to discount on notes payable of $497.38. So my ending balance on my discount on notes payable is going to be over here at $347.12. So if I'm doing this as a journal entry, my journal entry is going to be a debit to interest expense, credit to discount on notes payable. So this is going to be a debit over here of 150.26, 150.26, and this will be as of 12/31/29. And I'm going to bring this down over here just to give myself a little bit more breathing room to this part over here. Okay. So let's go through and take a look at this so far. Okay, so as of 12/31/29, my discount on notes payable is now going to be at 347.12. So my new carrying value and my notes payable is going to be 1653. Again, the journal entry I'm going through to record this is going to be a debit to interest expense, credit to discount on notes payable, and this is going to be to record interest expense. Okay. So the first journal entry I did when I was doing this over here for YYZ, I recorded interest revenue. So now I'm just going to be doing the opposite thing. I'm going through and recording interest expense. So let's now go ahead and look at the next time period, or 12/31/30. So my notes payable net now has a carrying value of 1653. I need to record interest expense because really what this represents is borrowing money. So again, with accounting, if it's a zero interest, if there's nothing being shown, you have to blow through those shenanigans and basically say, no, this really represents a borrowing amount. So when you see something that's like a zero interest rate, you'd have to go through and do this computation for under GAAP. Okay. So now we have our carrying value, or basically our interest expense is going to be 165.29. So this was the journal entry that we did on 12/31/29, 12/31/29. So my ending balance as of 12/39 was 347.12. I bring this down over here. Remember, interest expense is going to be closed out to zero, right? Revenues, expenses, dividends, all closed out to retain earnings. So here, my interest expense, so my discount on notes payable over here as of 1/1/30 is going to be 347.12. It's the ending balance of the prior period. Okay. So now I'm recognizing interest expense of 165.29. I'm going to credit discount on notes payable. And this over here is going to be 181.83. So come over here to record the interest for 12/31/30. This is going to be 165.29. Okay, so looking at my balance sheet, now when I get to 12/31/30, okay, I'm going to have to pay that $2,000 in the next year. So what I'm going to do is I'm going to move this now to current liabilities. I'm going to have a notes payable plus discount gives me notes payable net now as a current liability. That was a mistake I made on the other one. So coming over here, my notes payable still shows at 2,000, but now my discount on notes payable as of 12/31/30 is now at 181.83, giving me a total of 1818. So this is what I did over here on 12/31/30. And this over here is going to be my ending balance. Now, this is the big year because we're going to be paying this off. So when we do this last year, I like to do it in two components. I want to recognize the interest expense first. So let's go ahead and pull this down. So my balance on 1/1/31 is going to be 181, basically 83. And I'm now going to have to basically record my interest expense. Let's go through and see how we do this. Let's make things interesting. couldn't help myself. Okay, 12/31/31. My notes payable net has a carrying value over here of 1818, my interest rate of 10%. So I have this over here of 181.82. Again, numbers are a little bit off, but we'll go through and figure that out. So here I'm going to record interest expense of the carrying value of the note, which I get by taking the note payable less that discount. And then this gives me over here 181.12. But I'm going to go ahead and do the whole thing, 181.83. And this is going to take my balance down to 0. So first thing I want to go through and do is I want to go through and record 12/31/31. I'm going to record my interest expense over here at 181.83. So I'm recording the interest expense, crediting the discount on notes payable. Now, when I do this on 12/31/31, the magic happens, right? So once I go through and record this, this is basically now at 0, right? So now this is showing up here on my balance sheet tentatively at $2,000. So the very last step on 12/31/31 is I'm going to be crediting cash, and then I'm going to be debiting notes payable. So right over here, this is the journal entry I'm going to show to record the payment of that note. So again, these concepts with present value are absolutely critical for you to kind of go through and understand. And remember, how do I know that I did this question correctly? Well, when I go through and do this, when I make that final payment, if I'm off by a penny, that's okay. But this note discount on notes payable should typically be going down to 0, right? So this should essentially be a 0 balance. So that's how we solve a 0 interest problem where the note is a lump sum. Thank you for joining me here today. Glad you were here with me. And we're going to do installments next. So I will see you on the next video. Have a great day.